Hello, everybody. It's a good day to be alive. Today, we have an interesting video. As you guys know, I've been pretty much like the Starbucks warrior, the Black Knight this last couple weeks. Just a lot of slander regarding the company and a lot of people on Twitter who are just suddenly switching up because the stock is down and it's fun to dog on it. So I've been the warrior. A lot of people don't understand where the debt actually comes from, that they have store leases and are doing capital expenditures, and they like to ignore some of the positive fundamentals. And I think as somebody who proclaims himself to be a long-term investor, somebody like me who is investing for 10, 20, 30, 40 years, I believe it's my duty and my right to be the common sense, the common voice here, all right? Somebody a little rational who acknowledges some of the bad stuff, but also kind of puts you a little back. It puts you in your place. But today we have a good one. I've been getting blown up about this on Discord and video suggested from channel members. But Joseph Carlson apparently made a video going over Starbucks stock. So today I'm just going to be reacting to it. I haven't watched it yet. I've planned to, but I have not. So it's going to be a good one today. And before everybody, if you want to leave a hate comment or dislike the video, check out my podcast, at least Cash Flow Kings YT. We're going live tonight. I believe it will already be aired with Blake Downer. Stick to the end because I have a song debuting, and I think you guys appreciate it. But yeah, doing a lot of good work on there. The shorts game has been about that life. But regardless, though, I think we get into the video. Once again, no hate to Joseph. We are civil. This is going to be a good conversation. And I think it's good that we're having these, open conversation debates because it makes us better investors at the end of the day. But let's get into it.
Like I said, it's down 17% today. Now, the first thing I want to say about Starbucks is this is a company I really like. I think it's a really strong company fundamentally.
That's true. He messaged me that.
It has great brand value. It does have pricing power. It's a company that has a great loyalty program. Starbucks has one of the best digital assets with millions of members using it every single day. And it kind of works as a form of a bank. They get a lot of capital from their app that they can use in future investments. So I've been someone that's actually been bullish on Starbucks in the past. But there's been something that's changed my mind over time. Something that caused me concern about Starbucks in the future. I saw this.
It went down. I'm joking.
Across the horizon, getting closer and closer and closer. And I finally decided to sell my position because I feel like the risks were increasing for Starbucks. We can see that in my trading. If we look at my portfolio here, you can see my trading history with Starbucks. I was buying it in like the 70s and 80s, around 2022. And then I started to sell the company early 2023. So we can look at these sells here. I sold 1,000 of it here for 105, 102 right there. My last sell, my big one, July 24th, 2023, I sold $3,700 of the stock, the last of my position, at 103. The reason I sold out of Starbucks was because I felt like we were getting into a caffeine bubble. 4 months ago, I made a video on
that. No, I was not expecting that. Oh, man. Let me take a moment to digest that in. All right.
So you can go back and watch the video. I basically explained in this video that I believe there's too many companies entering into Starbucks' sphere. Too many companies. We have McDonald's having Cosmics, a new Starbucks-like drink type of concept where people just go through in lines.
It's one store, man. It's
on me locally, there's multiple places where you can go through drive-thrus and get your caffeine for the morning. You have Panera Bread actually killing 2 people with their highly caffeinated energy charged drinks.
All right, here we go. I think the argument with a bunch of the smaller local places, their risk has always been there, no? And I think Starbucks has a giant advantage over them, not only with the bank that they have, so they can obviously, as he mentioned, the bank, you could take out money from the app, interest free, use it as I know a lot of people are fucking panicking about the debt right now. Use that as a leverage against it. They can do analytics, build new stores, the whole triple shot reinvention plan that they're doing. Giant advantage over the small places that don't have that opportunity. The app itself is a complete complete mountain over these small coffee shops. So I'm not worried at all about the small shops. They've always been there. These little trendy locations. It's something that's always been there since Starbucks has been around since the 70s.
You have Jack in the Box coming out with an energy drink. You have other companies that are fast food companies transitioning to energy and caffeine based drinks. They all want to get part of this high margin industry,
Oh,
which is the caffeine addicted consumer group. And not only do you have the fast food industries, the Jack in the Boxes, the Panera Breads, the McDonald's moving into Starbucks' category, but you also have a whole other category that I think has significant overlap. The category there are the Celsiuses, the Monster Energy, the Red Bull. Now you have C4 Energy. You have so many other companies moving into this energy drink sphere. So when I saw that on the horizon, I just thought, you know what? Starbucks is at a healthy valuation right now. It's fully valued. I've done well in the stock. I made money on it.
one has said Starbucks' fair value is 130. Not me, but
I'm going to sell out now and move this money into companies that I feel a little bit more confident in.
all
So
right.
that's my initial concern with Starbucks. And like many of these theories, you don't know if they'll really hit. You don't know if Starbucks is just going to go right through these concerns and maybe I sold prematurely and Starbucks would continue to go up and have great same store sales. Or it might go the other direction where these concerns start to manifest through the numbers. Ultimately, the numbers will show you the truth. And this quarter, in particular for Starbucks, is the first time that I've seen real evidence of this caffeine bubble thesis starting to play out. I think we're starting to see real evidence here.
Oh,
Now, before we even go through the Qualtrim numbers, which look really ugly this quarter, I first want to show you some of the breakdown of just how bad this quarter was. This isn't just a stock selling down because of volatility or selling down because of a simple overreaction. These are really ugly numbers. We can look at the adjusted diluted EPS. That's the normal EPS number you want to look at. The Wall Street expectations were for 80 cents. They came in at 68 cents. So 15% below Wall Street's expectations. Revenue was also a miss. So they missed on the top and bottom line, revenue, and especially earnings. We have
revenue really wasn't that bad. It was 6%, but still, that you're expecting growth there with the valuations.
same store sales percentage. This is a major KPI that you track for any type of restaurant, any type of retail location. You have it here at minus 4%. Now, overall, Wall Street was expecting positive 1.46%. So Wall Street was pricing in that they're going to grow same store sales slightly. It came in minus 4%. This was also distributed throughout the entire globe. So this isn't some type of issue just between international or China or just the US. This was everywhere. Minus 3% in the US, minus 6% internationally, minus 11% in China. So China is getting crushed, the US is going negative, and everywhere else is going negative as well. Not great. And you can see that Wall Street was pricing in growing same-store sales everywhere but China. They had minus same-store sales everywhere, including China, and way worse in China than expected. You have the transactions, was also a huge miss. Wall Street was expecting it to be roughly equal, kind of in line, the same, minus 0.27, and it came in at minus 6%. So traffic volumes are going way down, both in North America and internationally. Again, you can't blame this on one single country or one single geography. You have ticket growth. So transaction is the amount of traffic, people coming in and out of stores. And then you have ticket growth, which is due to pricing, how much people are paying. Traffic is way down and people are paying slightly more, but still a miss on paying. Their ticket growth was 2%. Wall Street was pricing in 2.4. North America was 4%. Wall Street was pricing in 4.15. So that's one of the only metrics that they really hit. They came in with their ticket growth in North America. Not to mention, they missed North America's traffic by over 8%. Internationally, it was down big. Ticket growth was much smaller internationally, minus 3%. Then even in the new store openings, so you expect the company to continue opening up new stores. That's how they get new customers. Net new locations in North America was 134 compared to 144 expected. So they missed that by 7%. International was 230. Expected was 429. They missed that by 46%. So they're not opening up as many locations as expected.
Well, wouldn't you consider that a good thing now? Since like I've talked about this in the comments section in a few videos, but it's like you're struggling with some issues right now. Wouldn't you want to open up less stores and maybe focus on more of those core issues that are hitting your business right now? Like I know a lot of people were harping on Laxman, Narmashiran in the interviews for like that, but like they're kind of doing it. I mean, like, and they're still on long term projected to open up 55,000 stores by 2030. I really wouldn't focus on one quarter. Like it's we're investing for decades, not months.
And this is what I'm referring to. No matter which way you slice it, no matter which way you look at this, Starbucks missed on everything. They missed on every aspect of every part of their earnings. There are no good highlights about this.
Oh man. All right. All right. Now I gotta bring myself in here. I gotta intervene. They grew their memberships by 6%. Memberships are one of the huge things that are going to elevate their growth, long term. These are where their core customers are coming from. These are the repeat customers, those same store sales, all that good stuff. This is where the money is to be made for Starbucks. Their app that grew by 6%. Their lavender drinks, which are basically like the spring pumpkin spice latte things, they've seen just the same amount of success in those lavender drinks this quarter as they've seen with the seasonal drinks and the pumpkin spice latte. This is absolutely giant. This drives more people in the store seasonally. It creates giant demand. Also, they're still the number one go-to coffee option in China, which is a huge market away from at home. It's giant. It just shows they're not losing market share. Seems to be an outside issue. And long-term projections all still in place. 55,000 stores by 2030. They're making a new energy drink. So I don't know. I really don't consider like Celsius competition at Starbucks, but they're tapping into that market even more, adding more like gluten-free, plant-based options for that kind of customer base, which obviously I don't think a lot of those small coffee shops that he was talking about are going to tap into. There is still a lot of good, qualitatively speaking, coming from the earnings report. You got to listen to the earnings call. And as for the caffeine bubble argument, coffee has been around. It's the most addictive drug in the entire world, easiest drug to access in the entire world, second most popular beverage behind water. First, people are not going to stop drinking these products. I think that's been proven. People may cut back on it, but they're not going to stop. I think repricing could be in play for Starbucks. I understand that the financials were not good this quarter, and there's no way to go about that. But once again, as I've said, like Warren Buffett, he's talked about how you find a great business, you've done your due diligence in it. You aren't panicking quarter to quarter on what's going to happen. Warren Buffett talks about he doesn't look at Apple's quarter to quarter earnings. And I know that Apple to Starbucks may not be the best comparison, but I have the same level of conviction and due diligence that I've done with this company. Long term speaking, I'm sure Warren Buffett was not shitting his bricks in 1993 or whatever when Coca-Cola missed on their quarter two earnings. Like, let's be real, guys. Like, and I'm not too sure what Joseph's like long term. I know he portrays himself or brands himself as long term. I don't know if we're on the same level speaking long term. Like I'm investing for 20, 30 years. I think Starbucks is going to be around for a very long time. But let's get into the rest of this.
It's really hard to find anything to be really happy about this report. So in some cases,
Not if you listen to the earnings call.
I see stocks selling off and I shrug my shoulders. I have a hard time finding where the weakness is. In this case, I think this sell off is largely justified. I think that investors were totally blindsided by what happened here. And I think that Starbucks did a really bad job guiding investors' expectations into this quarter.
I'll say this. I think a big part of the sell off, too. I think Starbucks had a lot of pressure on it in the first place, just not to mess up. You had the whole Palestine boycott things, which I've talked about. There's a whole playlist. I've talked about stuff on this, like weeks back before. It was cool to shit on the company, but I think there was a lot of pressure on it before to just not mess up, man. You have the unions, which I think are kind of in the rearview mirror now, but of course they're going to resurface now that the stock is down. You have, China. You have a lot of the stock selling off in the first place before, trading it down. All right, so let's dive into the naughty financials now of Starbucks.
Expectations into this quarter. This was a huge communication breakdown between the management and their expectations and guiding and guiding investors in the right direction. Obviously, investors were caught way off guard. Now, we go down to the other metrics here, and we can see this show up in the longer term context. We look at the revenue here.
Oh,
I'll zoom in a little bit so you can just see this more clearly. See this last quarter? It's way down. Even from a year ago, you
I
had it
mean,
climbing, and then all of a
I really wouldn't consider that like a way down. They look at the pandemic. I would consider like that way down, but I really I like that the pandemic that long term context. It's not down. Not really.
sudden it fell rapidly. So the latest quarter, it's down big time decline
It's down 1.8%. I mean, I don't know if I'd consider that big, but it is what it is.
there. It looks unusually low. We look at the free cash flow, and this
Wait,
looks like it's growing
look,
over time. It looks unusually.
what? It, come on, man. I try. Like I'm trying to be fair, but like that's just it's up. Oh, it went down. It's bad. It's a bad company. It's crashing.
Low. We look at the free cash flow, and this looks like it's growing over time. So
The free cash flow looks worse than the revenue, man. The free cash flow looks worse than the revenue. Um, and a big reason of the free cash flow not being like crazy going up or whatever over time. The capex from building new stores. That's how you grow your business. That's where the growth is coming from, but also the debt that they take on with store leases.
the free cash flow I'll give them looks okay, but there's other issues with the free cash flow. A lot of this money that they earn this quarter is already spoken for, and I'll go into that a little bit later.
Oh,
When we look at the earnings per share, here's the other big miss. You can see earnings per share declining year over year. If I zoom in a little bit here, you can see this more clearly. This is the most recent quarter. We go back 4 quarters ago. That's what it looks like right there. So it went from
I've once again, it's quarter to quarter earnings per share. I'm not pooping my pants. I'm not going to sell out.
79 cents down to 68. Decline in EPS year over year.
Oh,
Now, they were guiding for around 15% earnings per share growth. And now analyst estimates are wondering even if they can become flat, even if they can just keep their earnings per share. That's how much of a blindside this was.
ooh.
When we look at the cash and debt, they took on more debt last quarter.
Building
So
stores.
long-term debt's going up during a time where interest rates are higher.
Now he's going to go on about this a little bit, but something that he doesn't mention is they have a little bit of a hedge against these interest rates. See, as he mentioned, since Starbucks has that app that kind of acts as a bank, they could take out cash interest free and use it however they please. They can also use that as a bit of a leverage against interest rates, which he does not mention.
Meaning that their interest on this debt is going to be much higher. And that's a problem for Starbucks. When we look at dividends, they're keeping their dividend, but this dividend's becoming an increasing amount of their cash flows, taking up a bigger and bigger proportion of their cash flows, leaving less amounts for things like paying down debt and doing buybacks.
Well, obviously, if they weren't doing capex and actually having to build stores and grow their business, I don't think, the free cash flow would look prettier, but the payout ratio also is a little higher than some people are comfortable with. I saw Simply Safe gave it like a 60 score, which was like borderline or whatever. Like they're using, if you look at the financials, they're using the debt to, build new stores, store leases. Like it's really not a big deal if you look into it. Like a debt is bad. I understand the debt is bad, but you got to do your due diligence here.
When we look at the shares outstanding, we can see a decline year over year, but it's not going down quarter to quarter. Outstanding was completely flat from this quarter to last quarter because they cannot afford to do buybacks.
There's still a chance that they announce buybacks. They've historically done buybacks. I wouldn't be surprised if they announced in the coming weeks that they are doing another program.
Key things I look for in my companies are ones that can afford to do buybacks if the share price plummets, because that's always a thing that can buoy the stock back up. It's a little bit of a margin of safety. If you have a company that has a ton of cash flow and it sells off big time, they can just buy back their stock over and over again, improving all of their per share metrics, making it so that it's really a matter of time until the stock goes back up.
I mean, I'm all for buying back shares at low prices, and I think we've talked about this a lot on the Cash Flow Kings, but what I'm not a fan of is investing in companies and hoping that they use buybacks to jump up their stock price. I want companies that improve their price over time and performance through actual cash flows and execution of the business. I don't want to be relying on a company to buy back, $3 billion worth of shares. Now hike the price up so I could get short-term outperformance. Like, I'm not huge on that.
Up. That's why I like investing in companies like Texas Roadhouse or
Ah,
MasterCard or Intuit.
good
All these
fun.
companies can pull a buyback lever if the stock price ever falls. The issue for Starbucks is they can't do buybacks.
They could.
They can't afford to. This year, Starbucks is going to generate around $3 to $4 billion of free cash flow. Okay, so they have $3 to $4 billion of free cash flow to do buybacks with. Seems like that's a good thing. They can buy back with $4 billion. But remember, $2.5 billion of that is already going to dividends. So $2.5 billion is spoken for going to dividends. Then they have debt payments, interest payments on their debt of $1.5 billion. So right there, all of their money that they're generating
They have that leverage, though. They have that leverage with the app.
in free cash flow is already going to interest payments and dividends, leaving them no money for buybacks. So as the stock price falls, they have no tool in their tool belt to really buy back the stock. The only way that they could really afford it right now is by issuing more debt. But that wouldn't make sense because then they're increasing the amount of interest payments they have in the future. So this is also a company that doesn't really have an easy tool to be able to fight back on this share decline.
They do have that money they could take out from the app. I'm just saying.
And that makes this situation even tougher for them. In order to do buybacks right now, they'd need to cut the dividend. And I don't think they want to do that.
Now,
So there's a brief overview of the
all right. He goes over the interview then, which we've already talked about on the channel, and I believe I saw a clip where he basically said it was rather lax Bernard Mashirin that was lying or misrepresenting the company. Apologies, or it was McDonald's, QSR, and maybe Yum Brands off the top of my head, based off market share. And I think that's just going to be interesting to play out. I think right now, it's a lot of people are not liking lax Bernard Mashirin as the stock price falls. Bad CEO, right? But I think there were some positives to take away. I think a lot of people weren't happy with his tone. It was maybe too formal for them. But I think I still a Laxman Bull. I've talked about him on the channel. I like the way that he's very involved with unionization efforts, but I also like the fact that the triple shot reinvention strategy or whatever, he's a big part of that. And I think that's a big pathway to the growth. He really values brand value and all the good qualitative measures of business. All right. Hope you guys enjoyed that. It was a highly requested video over in the Discord. If you appreciate it, make sure to smash the like button and subscribe for me. I'll also leave a link to Joseph's video in the comment section if you want to watch the rest of it yourself. Thank you again. And of course, smash the like button, subscribe, do dividends, stocks, and drugs. Have a good one.